I'm Anthony Valeri, Director of Investment Management at Zions Wealth. Thank you for joining us. The conflict in the Middle East has investors rightly fixated on energy prices, so today we'll take a look at oil prices and their impact on financial markets. Let's start by taking a longer-term view of oil prices to put the recent move in context. In early March, we witnessed one of the largest five-day increases in oil prices, and you'll see that the current increases is similar to what happened in early 2022, even if the magnitude is yet to reach that peak. This chart will also show you, however, that oil prices were routinely between $90 and $100 a barrel between 2010 and 2014, a period of relatively strong stock market performance. So a look back, putting this move in context, is helpful when we look at the impact for stocks going forward. History tells us that oil price shocks have a near-term but not long-term impact on the stock market. Here we rank some of the largest five-day moves in oil prices since 1990. And you see that March 2026 has seen a 35% increase. That's through the five-day period ending March 6th, and we'll ultimately see how stock market performance shakes out. However, if we look at the average performance of the S&P 500 after these oil price shocks, you'll see that performance over a 1, 3, and 6-month period is relatively subdued. However, after 9 months and 1 year, stock market performance is relatively strong. Even if we strip out the strong performance from 2020, there are two episodes there following the COVID pandemic, the average 1 year performance is still 15%, which is strong and above the historical average. So again, historically, oil price shocks have not had a long-term impact on the stock market. One area of stock markets that have been impacted by the recent increase in oil prices is the ongoing rotation that began in early November 2025. Other segments of the markets that were more attractively valued, such as emerging markets, small caps, developed international, and the S&P 500 equal weight index, all outperformed the S&P 500, which had been the strongest segment of equity markets. That mega cap tech dominance began to fade then, but in recent days has reemerged. Although the S&P 500 is still down on a year-to-date basis and underperforming these other segments of the market, the gap has closed as developed international, emerging markets, and small caps have underperformed the S&P 500 since airstrikes began on February 27th. One area of rotation that we think will continue is that of low-quality versus high-quality stocks. In 2025, low-quality stocks outperformed their high-quality counterparts by a significant margin. We can measure that by looking at a variety of metrics, starting on the left with low-quality earnings per share versus high-quality, or low earnings versus high earnings, the return on equity, low return on equity versus high, similarly, low profit margins versus high profit margins, and then high beta versus low beta, and then low share price versus high share price. You'll note the performance again, 2025, strong outperformance, but in 2026, that has reversed. And we think that will continue as high uncertainty will keep investors focused on higher quality stocks. And if history is any guide, high quality will resume its leadership. This is a look at a high quality relative to low quality US stock index from AQR. And you can see that over the longer term, high quality stocks outperform. The rising line means that high quality is outperforming low quality. It's not uncommon to have periods where low quality stocks outperform high quality, but that typically comes out after a recession. And the recent underperformance of high quality is quite startling and extreme on a historical basis. So we think that current trend continues as we focus on high quality stocks going forward. I'm Anthony Valeri. Thanks very much for joining. We'll speak to you again soon.